Hi and good evening. It's Monday, 25th of June 2018. Welcome to Trade the Markets Profitably with Admiral Markets, the Open Range Breakout with our moderator and presenter Jens Klatt. Let's have a nice evening together and let's have a nice start like every day, and we start like every day with our disclaimer. Forex and CFD trading are leveraged products or leverage trading and can result in losses that exceed your deposits. If you're a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and personal risk management. If you'd like to read the full disclaimer, just visit one of our web pages, for example, admiralmarkets.com, and you will find everything written down there. Of course, if you'd like to trade Forex and CFDs, you will get many benefits only with us. For example, DAX 30, one of our bestseller, 2 spread of just 0.8 points during the main trading hours. Check all the details out on admiralmarkets.com. It's the last weeks for retail clients in the European Union where anybody can choose at Admiral Markets leverage up to 500. From 30th of July, you will get as a retail client in the European Union the maximum leverage of 30 for the Forex majors, and for some others like indices like DAX 30, maximum leverage of 20. If you may be a legal professional client, then you can apply for the professional client status, check all the differences out. Here's the link in the webpage. And if you like, you can also call or send us an email if you have questions about all about that. On the webpage, you also find something about our regulatory background and how to contact us. You can send us email, you can call us, and many, many more. All, of course, linked on admiralmarkets.com. So enough from my side. Now it's time for the main day trader, the main organizer. Jens, hi, good morning, good evening, wherever you are. It's a global webinar, so let's have a nice start wherever you are.
Yes, hello and good morning. I'm in fact sitting at the beach right now on Tahiti. No, just kidding. Yeah, thanks for the warm welcome. And today is in fact a very spectacular trading day. If you had a look at the markets, everyone can see that currently, for example, the DAX European equities are trending strongly lower. It's not that surprising, let's say, because trade war fears started already to build here last week on Friday into the close of the trading week with the comments from Donald Trump, who now, after he attacked China, is about to attack the European Union in terms of potential tariffs. He plans to extend here above what they already brought up, and where the Chinese not yet reacted, but probably will, and where he said that here on top of the current tariffs from the US, if the Chinese will react, there will be another 200 billion in terms of tariffs then from the US. And if the European Union does not take back its tariffs as a counter, they brought up here to the US, and we're talking about, I think, jeans and motorcycles like Harley Davidson and whiskey, I think. Then there will be tariffs of 20% on the European automobile sector, but especially German cars will be hit, like Daimler, like Volkswagen, like BMW, for example. And yeah, as you can see, the markets are trending strongly lower. And so, in fact, the thing is, what we could do, what we will definitely do, is we want to have a look at those 3 steps here, which are then, or based on which you can then formulate your intraday trading strategy for the S&P 500. Nevertheless, we want to have a look at the markets, and probably not only at the S&P 500, where we will have a live trading, by the way. So we will stress test this strategy again next Wednesday. So that will be on the 27th of June then, and here at 3 p.m. London time. It's 2 p.m. GMT or 4 p.m. German time in this case. So let's say it's 3 p.m. London, and we will stress test the strategy. Nevertheless, today we want to have a look also at, for example, the DAX here, and how this setup would have performed here. So I've already also a strategy for the DAX based on this open range breakout. You can adopt the strategy to several markets, in fact. So it's not only tied in this case to the S&P 500, but you can also trade it on the Dow Jones, for example, on the DAX. You can trade it in European, I'm sorry, not European, in FX markets, for example, based on the so-called Asian breakout or Asian range you have to form then. As you can see here, it somehow depends mainly on which time frame you decide to trade, respectively. How you define this range, for example, but you can also adopt this to other deep and liquid markets like single shares, for example. So I know that Admiral Markets is also offering single shares, for example. You could also trade this setup here on Google, Amazon, to name a few. And in this case, now we are focusing on US markets. So we focus here in this case then on US equity shares or US equities in this case and shares from the US. But you can also, for example, then adopt this to the treasury market. If you're like, I don't know, a Bund trader, for example, or you're trading the T-note future, this is the US. If you want the US Bund future, it's the same 10-year US Treasury notes in this case. So you can adopt this to many, many markets. The only thing you have to adopt is which range you plan to trade, and then based on which, in this case, in our case, what I can already say now, we have then to find a moving average based on which we identify our advantage. Nevertheless, the setup itself is all the time the same, in fact. So let's first of all here have a look at the definition of the open range. So we define the open range between 3:30 p.m. and 4:15 p.m. Central European time. So in this case, this is German time. We can go 1 hour back. That's then 2:30 and 3:15 London, for example, or 1:30 to 2:15 GMT. Doesn't matter. I'm taking the German time here, since this is my time zone. And once you have defined this open range, say, or this set, that means you're looking at the high and the low of this range. So where's the high within this time frame and where's the low? You then say, okay, now I have to find my advantage. Now the thing is, this is something I'd like to bring up here already, and I've done this last week already, and I want to continue with this, since this is something which you really have to understand if you want to trade the markets from a professional perspective, but also from a profitable perspective. Profitability arises, or no, let's put it differently. So what is profitability in trading? Profitability in trading means nothing more than the so-called expected value of your strategy, of your trading, is positive. So therefore, let me just write this down here. So the expected value, we will short this up to EV, in fact, but now this is expected value here. Then we have the hit rate, and you multiply this with the average gain, and then you subtract it, the loss rate, and you multiply this with the average loss. So, and if this number is bigger 0, then you have a positive expected value. So in fact, this number has to be 0 after commissions. That's one of the reasons why, and this is the perfect moment then to switch over to Admiral Markets here, and their products in this case. And there, since we are looking at indices right now, we want to have a look here at what Jens already mentioned here at the beginning, when he said that, for example, the DAX in this case, the DAX is one of the featured products, as is the Dow Jones, for example. And what's very important in this context here is the typical spread. And it's a spread, and there's no commission on top of that. But the spread, nevertheless, plays a very important role. So if you have a broker, for example, offering you DAX trading on a 2-point spread, while Admiral here in this case offers you a spread of 0.8 points, for example, or in case of the Dow Jones, when looking at the US markets right now, offering you a typical spread of 1 point in this case, while some other brokers probably offer you 2 points, or some probably offer you 4 points, which is not uncommon, by the way, then your choice is clear. You should definitely choose Admiral as your primary broker. Why? Well, because these costs here will have an impact on your overall profitability. So when looking here at this formula for the expected value, for example, the thing is that an expected value, we're not talking about huge sums here we will make. I will give you some further details on the approach we will have a look at here a little later, some real numbers we want to work with. But all in all, we can say that probably the overall money we will make per euro we will risk will be somewhere in the range around 7 to 8 cents. Okay, so that means that, for example, if I'm risking, let's say I'm trading a 100,000 euro account and I'm risking 1%, this equals to 1,000 euros then. If I'm making, thanks to the expected value, on average per trade, doesn't matter by the way if it's a winning or losing trade, if you make on average, let's say 7 cents, that means nothing more than that you're here, in this case, making with a 1,000 euro risk, in this case, so 1%, that you're making 70, 80 euros per trade on average. So now you might say, okay, well, that's not that much. In fact, it is. You have to calculate it on a yearly basis in this case. So you're not only making one trade, but you're making probably 200 trades a year. So this setup, which I present to you here, is an intraday day trading setup, which means you're making one trade per day. So if you're having, let's say, 200 to 250 trading days a year, that means nothing more than if you're making on average 80 euros, you're making 80 euros multiplied with 200, which equals at the end of the year to 16,000. 16,000 on 100,000 euro account means 60% per year. That's not that bad. But now the thing is, let's have a look here at the following. So now assume the following. We are here currently not taking the spread into account. Now take the following idea. Just imagine the following. We are risking, as I already said, 1% on a 100,000 euro account. 1% equals to 1,000 euros. Okay, now assume that the trading range we are looking at, let's have a look, by the way, at the Dow Jones here, even though we will have a focus on the S&P 500, but let's focus here on the Dow Jones, since it is much easier to calculate based on a 1-point spread. Well, in case of the S&P, also very low, it's 0.4 points. But the thing is that we then have to, it's a little difficult to calculate. With 1 point, it's an easy go through, and you can easily follow me in this calculation right now. So let's assume that the average Dow Jones open range here, average Dow Jones open range, is, let's say, 100 points. So now that means that you're obviously trading 10 contracts, right? So that, because if you're risking 1,000 euros, you have now to find out what is the position size you should take. Well, and therefore you divide those 1,000 through the 100 points, and then you have 10. Let's shorten things up here. DJ, it's for Dow Jones contracts. So case of a CFD in this case, okay? So you're trading 10 contracts now. So let's assume the following. If 1 point spread comes up with 1 point spread, that means that your costs here in this case per trade is 10 euro. Okay? Imagine, or remember the following. We just said that the expected value of our trade, that's something probably we have to fill in here. Expected value now is 80 euros. 80 euros per trade. Remember, expected value 8 cents, and then we're risking 1,000 euros. That means 80 euros per trade we are making. Now you have to subtract those 10 euros in this case. You're coming down on a net profit of 70 euros then. Now assume the following. You have a broker which is taking 4-point spread. This equals, if you're trading 10 contracts, to 40 euros. So what you just did was that you cut your profit in half thanks to the commission you have to pay, or in this case, the spread you have to pay the broker. In case of Admiral, in this case, for example, you're obviously only where you're 1/4 or 25% of those costs from this broker. So that's one of the main reasons, and you can easily adopt this calculation to every other asset you plan to trade. That's one of the main reasons why the spread matters when you're trading. So it's definitely something a professional trader will always and all the time have a look at. And he has no other choice than doing that. And this is, in fact, where profitability in trading, respectively, professionalism in trading then starts. Now, but this is the theory behind the spread, why this matters, and why this is, in fact, really, really important to take a look at. Now, let's have a look here back at the open range setup. The second step you have to do after you define the open range between 3:30 p.m. till 4:15 p.m. Central European time, you identify the advantage. This is something you can do in a very easy way. In our case, in fact, we'll have a look at the exponential moving average 10 here on a 15-minute time frame, and it's very easy. We say if we trade above, we trade long. If we trade below, we trade short. That's it. Very, very simple, in fact. What do we mean with trade long, trade short? Well, this means that if we trade above this exponential moving average 10 and 15-minute time frame, and we break out of this open range on the upside, we're going long. In fact, if we trade above and would break out of this range we just defined here and one on the downside, we're not trading at all. So we're not having a trading setup then. The same is true, in fact, for the opposite if we're breaking out on the downside. And in this case, we only trade if we trade below the 15-minute exponential moving average 10 here. We don't trade the short side if we trade above. And then what we do is we trade the break of the open range in direction of the identified advantage, so what I just said, and we place the stop above, respectively, below the high-low of this range, and that's it. So this is the three-step plan we follow. Many will probably say, I can't imagine that this is a profitable approach. I will just show you that it in fact is. By the way, some of you might raise their hands and ask, hey, by the way, where's our take profit? So placing the stop, okay, that's clear, but where's the take profit? I've not written it down since there are some ways to place the stop, in fact. And in our case, we're not placing a take profit at all, but we're taking the trade out manually at 9:50 p.m. in this case German time, or 8:50 p.m. London, and that's it. So we just wait till 8:50 p.m. London occurs, and if it if the clock hits 8:50, we just close the trade. If it's not stopped out till then, I will, and you will. This is the great thing about today. You can see why we do this, or when it really plays out, because this is something, if you have an automated strategy here, it's taking any pressure from you. So probably there have been several occasions today, in case of the DAX in this case. So the S&P has not yet trended really strongly in one direction, at least not during the current spot trading hours, so meaning Wall Street trading hours here, starting from 3:30 then German time till 10 p.m. German time in this case. So we haven't seen such a strong trend developing here. But when looking at the DAX, for example, you will clearly see why this is an approach which is over the long run obviously playing out, because this is something you will see in the backtest. I will present to you a little later on. But first of all, now next question probably arises from some, why the S&P? I mean, you're obviously having also some very attractive trading conditions in the Dow Jones here. Why the S&P? In fact, this has something to do with my start in the trading business, and to do with the fact that my mentor, the guy who taught me how to trade the markets, well, he traded the S&P future. So it was just that I duplicated his way of trading in this case. Yes. We will have this in a few seconds. I just want to give this anecdote. So MJ just asked whether we can see an example. Yes, I will definitely give one. But let's first of all have a look here. Why the S&P 500? So it has to do with the fact that my mentor back then traded the S&P. That's more than 10 years ago, in fact. And my approach in this case, when trading U.S. equities here, hasn't changed since then. So I've always traded the S&P 500, and I probably will keep on trading the S&P. From time to time, I have some swing trading ideas that happened, for example, last year. in the Dow Jones here, but most of the time I'm trading, especially when intraday trading, I'm trading the S&P 500. So this is the main reason why we focus here on the S&P 500. And now let's have a look here at an example. So I've already prepared, in fact, the I've already prepared the open range. As you can see it here, these thin lines. This is the candle which is starting at 3:30 p.m. German time, and this here. So we have to look at the first three 15-minute candles in this case, because the first 15 3-minute candles mean that from 3:30 we're closing here at 4:15 in this case. And what we then do, or what we can obviously see, is that we are breaking out here on the downside. This candle, obviously, there you can see the shadow of this candle. It's breaking below this thin line. And why do we go short? Well, we are trading below this blue line here, which is the exponential moving average 10 on a 50-minute time frame, as you can see it here. So how we do this? So in fact, currently you can see I'm not having a trade on. This is due to the fact that the live trading will take place then on Wednesday. And I will clearly show to you how you can use this fantastic tool here, the mini terminal, which you can download also as a, not only as a client from Admiral, but you have access to this tool here for free then, or while you're not having indefinite access to this tool as a demo client. As a demo client, you only have access to this 30 days, if I'm not mistaken. And yeah, so in this case, I will show you how to use this really great tool for intraday trading then on Wednesday. But nevertheless, I want to give you an idea on how you now trade the setup, even though it's not fascinating at all. It's in fact very, very boring. So profitable trading, for example, something which is, to some of you probably it comes as a surprise, but profitability in trading is in fact one of the, it's probably the most boring thing you can imagine. You have a setup, you just follow the rules which are preset, which you know which work in the long run, where you have a positive expected value, and you just go with it. That's it. Nothing more, nothing less. You just follow, in this case, you just follow those rules, and there we go. So in this case, we entered the market here with the break out of this range. As you can see, we're not following through, but we are bouncing back a little. Nevertheless, the thing is that our stop here is placed above this red line, the thin red line. Remember, step 3, we trade the break. Well, this happened here in this candle, while we place the stop above the high of this range, which was defined here at 3:30 till 4:15. And this is exactly where the stop is here, and obviously you can see it wasn't triggered, so no stop out. But in fact now the market is breaking out here on the downside and currently moving in our direction in this setup here. Now you can already see, well, the thing is, there is not yet a real strong trend developing. Okay, well, sure, you can see we started trading already here. That was yesterday, Sunday evening. So in fact, you can see it's the 22nd. Now you have to switch over here. We start, in fact, in this candle. And from here, when we started at around 2,752, we already trended strongly downwards. I mean, we have seen a loss so far of more than 1%, and in this case, 50 points. And here, but compared to the DAX, for example, this from here, this is a spot trading hours currently. Compared to the DAX, this is not a strong trend, but this is a strong trend. So this is the same the same chart, if you want. Not really, because it's a 5-minute chart, but nevertheless, the approach is still the same. So for example, for the DAX, I adopt this setup here. In my case, this is, for example, not a 10 exponential moving average 10, but it's a 50 exponential moving average 50 here on a 5-minute time frame. So now people start to wonder, wow, well, wait a second. So 50-minute, if we divide this by 3, we multiply the exponential moving average in the S&P then by 3, while dividing the chart by 3. Well, this means that you're very close in this case, right? So when looking at the 50 exponential moving average on a 5-minute time frame in the DAX, that means that if you trade the S&P, would look at the 30 exponential moving average. Somehow, yes, you could bring it down to this, even though we don't want to overcomplicate things here. But it's in fact true that the open range breakout approach could be adopted here to a 50-minute time frame. But also here, this is the next thing. I started out as a 5-minute DAX trader intraday, and I never changed this. So that was also something my mentor back then did. So this is something which I also taken over from here, even though I have to say, for example, that I started also on a 5-minute time frame in the S&P and now switched over to the 50-minute time frame, even though, again, it doesn't make such a big difference. And so what I do here is then I look at the open range in this case. So in this case, looking at the time frame, obviously different trading hours, European trading hours. The FDAX, the future DAX, starts at 8 a.m. German time, and then ends, in fact, at 10 p.m. German time. Nevertheless, at 9 a.m. German time, we see Xetra open. This is when the spot market comes to life. And after 5 minutes of Xetra trading, I then define the open range. So in fact, the open range in the DAX then is from 8 till 9:05 German time. And then you get this here. And I say, if we trade below, in this case, this blue line, which is the 50 exponential moving average on a 5-minute time frame, I'm going short. And I'm going long if we trade above that and break out on the upside. So same thing here. We were triggered short. The market breaks out of this range. Stop is placed here above the highs. That was a little closer, let's say, but also here you're not stopped out. And currently the market is strongly trending in my direction in this case. So it's trading. It's 200 points, 250 points lower. Yeah, around 250 points lower from here. So, and this is exactly where the money is made. Then you do not have very often these trading conditions, but if you have them, you have to really try to capture most of this trend, because these are the trades which are bringing your equity forward. So what I'm talking about is in fact the following, and therefore let's have a look here again at these at the slides I prepared. So I have the example here. You can see it then in this case on the long side. Nevertheless, we already had an example which was also explaining this, in fact, for 2 markets, not only the S&P, but also for the DAX. But what we want to have a look at here is this backtest result, because people now wonder, is this really profitable? Can this be? And in fact, yes, it is. It's in fact the easy approaches and the simple approaches which are working in the long run. It's always the same. Some of you might have heard about the so-called KISS approach, keep it simple, stupid. So in fact, the approach is profitable. Nevertheless, it's, even though it's a very easy approach, and what do I mean by that? Well, again, I'm sorry. If you follow these 3 steps, and you can just screenshot this. You just screenshot it and work through it yourself, test it yourself. It's very simple. It's a very, very easy approach. The thing is that many people out there just can't follow these rules for a long, long time, because, and this is something, for example, the back test perfectly illustrates here, you have a win rate of only 47%. Which means that you're more on the wrong side than you're on the right side. And even if not, well, we're still talking about being nearly wrong 50% of the cases. So it's every day a coin flip, if you want, nothing more than that. Now the thing is that, and this is what I want which is obvious here in this case, nevertheless, the equity curve, so the backtest result in this case, is obviously showing that you see a rising equity curve. So you're making money. So where does the money come from? If you have a hit rate of only, in this case, or not only, but slightly, in fact, below 50%. And therefore, let's have a look again at the formula here for the expected value, which I already wrote down. So if the hit rate is 50%, let's round this up to our advantage, while round this down here also to our advantage in case of the loss rate. So if this is only 50%, well, obviously the average gain has to be bigger than the average loss, because only then it's possible to generate an expected value which is bigger zero. Else, obviously, we can't make money, right? Because if you have 50% here, you have 50% there, well, average gain has to be big, while the average loss has to be small, or at least the average gain has to be higher than 1 to 1. Else, you're not making any money. Why? Well, because you also have to count those spread parameters, respectively the commissions, into your trading approach. So now it becomes obvious what I want to show to you here. Well, obviously you have to catch those trends, because these trends are pushing your equity in your direction, because this is what is giving you the average gain you need to be profitable with your trading approach, right? So, and that's why it's that these days, it's not very often that they happen, but when they happen, you have to really stay strong and do not try to say, okay, well, after the breakout occurred here, well, probably now I'm taking out the trade. Probably now I'm taking out the trade. Just look at this, for example. I mean, we're looking at the DAX here. We will switch back to the S&P, but the DAX is so perfect for today's webinar that we want to have a look at it. Just imagine here, you've seen the market pushing in your direction. You're entering the market at 12,490, and you see it's trading around these lows here, 12,399, so 12,400 points. So from here to there, you're making 90 points. Okay. Now the market is coming back. In this case here, 45 points. So it doesn't look that big because it's such a strong trend today. Nevertheless, this is a pullback, and it's taking back nearly 50% of your gain. And it feels like you're trading break even. That has something to do with trading psychology. It's something we all know as something called loss aversion. So losses are considered to be twice as painful as a gain in the same region. So meaning if you're making, let's say, 50 points, it feels like you made 50 points. If you face a loss of 50 points, it feels like you just lost 100 points, because it's twice, the pain is twice as high. So, and there are many people out there who just can't stand this pain here, seeing the market moving 50% against them, feeling like they just gave back all their gains from here. And by the way, we're talking about this trend developed here over a time span of nearly 8 to 9 hours now. So it's also time consuming if you want. If you're sitting in front of your screen, you see the market trending, yes, but every candle is a 5-minute candle, and this is taking hours now. So obviously, now a quote here from Edwin Lefebvre's biography of one of the biggest speculators of all time. It was Jesse Livermore becomes, or it makes sense. Jesse Livermore once said, it was never, what made me the most money was my sitting tight. So that is the patience he had. This is what made him the money in his trading, in fact. And this is true, especially during such market conditions, because now let's have a look back here at this backtest result. Just imagine you're taking back those, you just take your gains, let's say of 90 points or something, because you just can't stand it that the market moves against you here of say 40 to 50 points, and you just take this gain of 100 points or 90 points in this case. Well, the thing is, when looking again at this chart, currently we are trading nearly from this moment here, from 12,487, we're taking more than 200 points. So this is twice as much you currently see on the or in your P&L than you would have if you've just taken out the trade here, because you can't see the market moving against you. Okay, and this is something which you always have to remember when looking at this formula in this case, because we are not only talking about one trade in this case, but we are talking about many trades. It's not only one. In this context, and let's have a look again probably here, first of all, at this backtest result. We are looking at the number of trades here of 1,347. So we're not only looking at one trade, but more than 1,000 trades. And over this period of, in this case, something like 7 years, you had a hit rate of 47%. So it's nearly 50-50 if you want. And the payoff ratio, so the average gain was 1.3, while the average loss then in this case was 1. So with this, the expected value of your strategy is these 8 cents per euro you risk. And if you do this often enough, what do I mean by do this often enough? The mistake, taking your gain here while not having having the patience to wait for such a trend to develop here, this will seriously hit the overall expectancy of your trading strategy, if not making it unprofitable, in fact. So, and this is exactly the thing. You probably have a positive feeling taking the gain here, and from time to time you will be right, and the market will probably start to reverse from here. You will just say, hey, I just made 90 points. But the thing is, you have to really see whether your approach is profitable over the long run here, and not only for only one occasion in this case. So this is exactly where profitability in trading comes from here, and where expectancy then starts to play a role, and where there's the difference between profitability in trading and unprofitability in trading. So to some of you, this probably is now a little, it's probably too theoretical here. Nevertheless, I probably want to dig a little deeper and take the current World Championship soccer as an example here. And therefore, and I want to make this a topic because I really love this interview after the game Germany-Sweden last Saturday. So, I mean, as a German, I'm obviously happy that Germany just scored, or in this case, Toni Kroos just scored in the 95th minute here with this beautiful free kick, and made many, many Germans really, really happy. But what made me even more happy was when he made his mistake in the first half, which led to the 1-0 for Sweden, a topic here, which we can now start to make a topic here and use as a perfect example of how expectancy here works in the world of trading. So what happened was the following. Toni Kroos made a mistake in the first half. Probably most of you have seen this game here. And what led, in fact, to the 1-0 for Sweden in this case. So now, what Kroos said after the game in this interview was the following: when the reporter asked him, "Hey, it wasn't such a great pass you just played there, right? And that resulted in the goal for the Swedish team, and that was a very close one, because that was nearly the mistake which cost us this tournament here." And Kroos did the following. He looked at him and said, "Well, what do you expect? I mean, if I'm passing 400 times a game, well, 1 or 2 passes won't make it to my team comrade here. I mean, and in this case, it's definitely something to be really, annoyed about, let's say, because this one pass which didn't make it was obviously the one which led the Swedish team here to score. And this is something which really rose my attention, and I started really to have a look here at what he's talking about when referring obviously to 400 passes. Obviously, Kroos didn't pass 400 times in this game, but something I want to make a topic here, because this is obviously perfectly illustrating how important it is not only to focus on one trade, but on all trades, on hundreds of trades here, and then see how this affects your overall profitability. Let's have a look back again here at this example where you take those 90 points here, now seeing the market moving strongly, trending strongly in our direction. So let me just delete this here and now have a look at some stats here I found after the game. So in fact, first of all, I'd like to point out, I've already written this down here on another screen, so I just can copy paste it from here. First of all, Toni Kroos touched 144 times the ball during this game, which is a world record for a German soccer player during a World Cup tournament. So there has never been a player before who touched that often the ball. So that's the first thing. So obviously all eyes were naturally on him, because he was the center of this game. Next thing is, and this is something which is not only true for the game here last Saturday, but it's also true for all games. His overall pass success percentage is 93.2. So that means that in 93.2% of the cases, his passes succeed and come to his team comrade, which is perfectly illustrating what he was referring to when saying, well, if you're playing 400 passes, well, obviously, in his case, then let's say 100 passes, 7 won't make it, okay? And it's, well, if then one of those 7 is the reason why the Swedish team in this case can score, well, that's not so cool, let's say. But nevertheless, the thing is that he is the one who is doing that over and over and over again. So I checked the stats here for the whole season, last season in this case, at Real Madrid here. And in fact, he averaged 93%, I think it was even 95 to 96%, a pass success percentage in this case. So it's it was a really good game, or it was his average. So he would have been better if every pass just made it, but if every pass made it, the reporter had no chance to ask such a question like, well, how do you feel after being the reason or being the one who made the mistake which led to the 1-0 here for the Swedish team? So why do I point this out? What has this to do with trading? In fact, a lot, because we can come back here to this example where we take those 90 points at in this moment here, and not letting the market run in your direction. The thing is, you obviously probably feel happy the moment the market then turns around here and is probably pushing back to this open range, probably making new highs, whatever. The thing is that if you cannot stabilize this, and if you're in the long run only see probably this one-time success here, which is the same as the mistake they reported it when he referred to his mistake, not seeing that more than 90% of his passes succeeded. The problem is that this can hit the overall profitability of this trading approach, respectively, make the reporter in this case really look silly, because it's a silly remark. It's just that he didn't make his job, right? Because he's referring to one pass which didn't make it, but which is nevertheless something we call a cognitive bias in behavioral finance, for example. So he's only referring to this one thing, to this one occasion when the pass did not succeed here and did not make it to his team comrade, while not seeing the overall success which Kroos brought to the success of the German team in this case. And this is something you definitely have to avoid, because again, this is something which will definitely be negative for your overall profitability. Or let's put it differently. Let's imagine today, this is the other way around. You're on the winning streak here, and then you see the market moving strongly in your direction. You're obviously making a good amount of money. So just to refer to my trading, for example, for today, yes, I was short. It was another strategy. Nevertheless, I was short. And now the thing is that and this is something you probably will smile about now, that I already took my gains on the trade. It's not a trading approach. But the average price I just realized my profit on was 12,312 points. This means I know when the basic strategy I'm trading here, I know when this basic strategy will end the day and take out all positions here. And then I will do the following. I will have a look at where the market is currently trading at this moment. Everything above 312 means I just made a bigger profit than I would have made in case of only trading the basic strategy. While if we trade below 312 at this moment in the future, and this is something like 3.5 hours from now, in fact, I will score less than the basic strategy and made a mistake. So this is how I calculate my mistakes in my trading. If I made a positive mistake, I will get a plus in my trading journal. If I made a negative mistake, meaning I would have made more if only trading the basic strategy, I get a minus for today. And this is what I do over a long time span here, not only for one trade, not for 10, but I'm right now doing this for hundreds of trades. And while doing that, the great thing about it is that after, let's say, 100 trades, I'm capable to say, did I perform better than the strategy? If I did, great. I can say, well, I'm obviously a very experienced and successful trader. If I don't, I have to wonder why. And if I can't overcome it, let's say within the next 200 trades, well, I have to stop intervening into the strategy and just leave the basic strategy as it is, since the basic strategy itself is making more money than I do with my interventions into the market. So in my case, I can say that I'm right now really successful over this time span of, like, I don't know, 250 or 300 trades or something. And currently making something like 300 to 350 points more than the basic strategy. Nevertheless, if things turn around, and they did, by the way, during the high volatility during February, some of you might remember the flash crash in the Dow Jones and everything, then I have to wonder what just happened here. It's not that I didn't make money during this time. I was a really happy guy because many people lost lots of money during this high volatility when there was this huge surge in the volatility index in the US equity markets. Nevertheless, I performed way below what my basic strategy I'm trading would have, where it did perform or it did generate in profits here. And that's something you really have to wonder about. This is where you then see that trading is not only about looking at trading today or in the next week, but it's a path you're following over a long time and try to evolve here over time, in fact. Yes, so that's it. That's it mainly from my end. I think it's a perfect point to end this webinar and to say I really look forward to Wednesday, 3 p.m. London, so 4 p.m. German time. I really look forward to it. There will be a live trading event here, and we will stress test the strategy. And I will give you, yes, I will give you some further insights. So I just saw that okay, everything fine then. Perfect. Yes, so that's it from my end. Have a nice evening.
Yeah, greetings from Berlin office. Here you see the admiralmarkets.com webpage where you see all of our webinars. For example, we also offer real-time daily trading ideas 5 days a week, 5 different traders every day to the same time. Check them out. All our webinars are free. So admiralmarkets.com, in the education section, you will find all our webinars. See you. Have a good evening or a good morning wherever you are. It's a global webinar. So running gag. Greetings from Berlin office. Bye-bye.